I'm going to consider traditional IRAs that are inherited. First, let's consider an account owner who was under 70 and a half when they died. When the spouse inherits the money as the sole beneficiary, she would transfer, or he, into their own IRA or an existing one or a new one. Uh, they would be subject to a 10% penalty if they took the money out before 59 and a half. Under the life expectancy method for that owner under 70 and a half, the spouse would transfer money into an inherited IRA held in their name. The distribution must begin by 12/31 of the year the account holder would have reached 70 and a half. For a non-spouse, distribution would begin no later than 12/31 of the year after the account holder died. The distributions are calculated using single life expectancy, determined by your age in the calendar year following the year of death. That would be the case um, for this situation and others, as I'll mention. If there are multiple beneficiaries, separate accounts must be established by 12/31 of the year following the year of death. Otherwise, distribution will be based on the oldest beneficiary's age, which would accelerate distribution. There wouldn't be a 10% early withdrawal penalty for this life expectancy method, and the either the spouse or non-spouse can designate their own beneficiary. For a situation in which the money is going to be taken out within a 5-year period, the spouse or non-spouse would transfer assets into an inherited IRA held in their name. All the money must be distributed by 12/31 of the 5th year after the year in which the account holder died. There wouldn't be a 10% early withdrawal penalty. They may designate their own IRA beneficiary. Lump sum distribution, that would be what that implies. All the money's taken out, it would all be taxed. Of course, there would not be a 10% early withdrawal penalty. That would put you into a higher tax bracket. Okay, let's consider a traditional inherited IRA where the account holder was over 70 and a half. For a spouse, transfer the assets into their own existing or new IRA. A 10% early withdrawal penalty would apply if they're under 59 and a half. This would be available to a spouse who's the sole beneficiary. They must take an RMD if the deceased didn't by the end of the year, if they die. And the spouse could designate their own beneficiary. Okay, so let's consider a life expectancy method for a spouse or non-spouse. They would transfer assets into an inherited IRA in their name. They must begin taking RMD distributions over their life expectancy no later than December 31st of the year following the account holder's year of death. Annual distributions must be spread out over a single life expectancy determined by their age in the calendar year following the year of death and reevaluated each year, or the account holder's remaining life expectancy, whichever is greater. If the account holder didn't take the RMD, of course I mentioned, must take it by the end of that year they died. Multiple beneficiaries, separate accounts must be established by December 31st of the year following the year of death. Otherwise, the distributions for all the beneficiaries will be based on the oldest beneficiary, which would accelerate the payments. RMDs are mandatory, and the spouse or non-spouse can designate their own beneficiary. Third choice is a lump sum. Take it all at once. That'll be taxable. There wouldn't be a 10% penalty. Of course, that would put you into a higher tax bracket. Any questions, give me a call. I can perhaps help or find a state tax attorney for you.